which is how can we improve a trade deficit, which is actually pretty important in the UK economy because the UK now is at a trade deficit for 29 out of the last 30 odd years. In fact, the last time that we had a trade deficit was in 1997, and that's probably due to the falling out of the exchange rate mechanism, which meant that the exchange rate fell by about 25%, which therefore meant that the trade deficit did eventually improve, and that's why we got a trade surplus in the year 1997. However, at that moment in time, 20% of gross domestic product was taken up by the manufacturing sector. So when the exchange rate fell in 2008, everybody thought that perhaps by the year 2012 we'd be sort of moving into a trade surplus again. In fact, by the year 2013 we had a very large trade deficit. Probably the main reason why this happened was because our manufacturing sector is now only 10% of GDP. So what we're looking at now is the trade deficit and how we can improve it and what are the conflicts involved. Now, firstly, one of the main ways in which we can improve it is we can just reduce the exchange rate. Pretty easy. How do you reduce the exchange rate? Well, what you need to do is you need to reduce the interest rate, and hot money will move abroad, and therefore the exchange rate will then fall. The second way, what includes everything, obviously, is supply-side economics, using microeconomic incentives to achieve macro goals. If we use supply-side economics, therefore we become more efficient, therefore we innovate more, so therefore hopefully we'll sell more exports because, for example, once again, if we decrease corporation tax, to 21%, then exports will start to move upwards. Another way which people are now talking about is we need to improve the infrastructure of the UK economy, so you can invest loads of money into broadband, roads, rail, airports, anything that will make our companies more efficient, will attract more foreign direct investment into the UK. If you've also got supply-side economics with its labour market flexibility, good training, good skills, that will also attract more foreign direct investment, and therefore eventually we will sell more exports. Another way, which is what we used to use in the past, was we used to lower AD, because if you lowered AD, that would therefore mean that we would buy fewer imports. But this is the last policy that we want to use in 2014. Our whole mantra is we want to increase AD, because we want to get economic growth. We can do that because we've got a negative output gap, and of course if we get positive economic growth, then we can start to pay off our national debt. So we're addicted to growth, so it's the last thing we'd want to use, however you could use that. Finally, I've just spoken previously about South Korea, and South Korea invests 3.5% of its money into research and development. If we did the same in the UK, therefore we would innovate more, therefore we'd have more products to sell, therefore we would sell more exports. A bit of history about it, I've already covered this, 30 years, 29 out of the 30 years we've had a trade deficit. And fundamentally, if you have a trade deficit again and again and again, you have to pay for that. And you may even have to borrow loads and loads of money, which makes the economy unstable. And in fact, those economies in Europe which had very large trade deficits, e.g. Spain, 10% of GDP, Greece, 11% of GDP, I think fundamentally it was because they had trade deficits that created a lot of their economic problems. Now, you can't exist like that again and again. We've been very lucky in the UK because we have been able to attract a lot of foreign direct investment, which actually pays for our trade deficit. Anyway, the last time we had a trade surplus was in 1997, and that was probably because the exchange rate fell. And in the year 2013, we had a record trade deficit, which was 5.3% of GDP. So the reason why we have a record trade deficit during this period of time, even though we were still only recovering from the recession in 2008, was because we have a very high import income elasticity of demand. So as our incomes rise, we always go out and we buy more imports because fundamentally we don't produce that many more goods. Right, a key feature of why we might want to have a lower exchange rate is that we need to rebalance the whole economy, and that's going to take a long time because eventually, as import prices go up, people will not want to buy those goods from abroad, and entrepreneurs will suddenly start thinking, actually, perhaps we can produce the same sort of goods in the UK. And I think to a degree this is happening with energy, because people are now very keen on cutting their energy bills, and they do that through home insulation, etc. If everybody does that in the UK, then we're going to import less oil. So that would have a significant impact upon the balance of payments. In fact, I would like to do some analysis on it to really work it all out. However, so what happened then in 2008, our exchange rate fell by 25%. We previously had this in 1992, 1996, which was a very, very successful time for the UK economy. The theory is, examiners always like theory, that if you reduce the exchange rate and the Marshall-Lerner equation holds, then if the sum of the export and import elasticities are greater than 1, then a fall in the exchange rate will lead to an improvement in the trade deficit. The key point though is, in the short run, the Marshall-Lerner equation does not hold. So the possibility is, does not hold. So the possibility is that the trade deficit will actually get worse. So what does that mean? If we take the example of oil, which has an inelastic demand, as we all know, then if the price of oil, say, doubles, the demand for oil will fall by a much smaller proportion, so that may fall by 10%. So therefore, because the price of oil has gone up, we are now going to be spending more money on oil than we did previously, even though the price has gone up, because it's got an inelastic demand. So therefore an exchange rate could actually worsen the trade deficit. What we hope is, in the long term, and the problem with oil is it takes a long term to create new industries. In the long term, we may create new industries, renewable technologies, make them into play, because if the price of oil is really expensive, some people believe the price of oil is $100 a barrel, then green technology becomes appropriate at that time. Certainly home insulation does. If it gets up to $150 a barrel, then green technology will actually pay for itself. So slowly we will create these new industries which will stop us importing the oil. Once again, we innovate. So we innovate, then we can create new industries from there. However, a fall in the exchange rate will definitely improve the trade deficit. And it may be worthwhile having a little look after this lesson is how you can actually improve, what factors will influence the exchange rate when it moves up and down. In the UK we have a floating exchange rate, and what that means is that it's determined by the supply and demand of sterling. Okay, there's always going to be conflicts involved, and the conflict is, as the exchange rate goes down, that leads to high cost push inflation because the price of imports will go up immediately, and that then creates a problem for the UK economy. In terms of the UK in particular, is that everybody becomes poorer, and if people become poorer, then they'll stop consuming goods, and the major part of aggregate demand happens to be consumption. It's 2/3 of aggregate demand. Even though this is necessarily about a falling exchange rate or how do we improve the trade deficit, we must have supply-side economics, okay? At the end of every essay, you must have supply-side economics to underpin what you're doing in terms of the falling exchange rate. In a way, a lot of these policies like printing money, reducing interest rates, reducing the exchange rate will definitely improve the UK economy. But underpinning it at all times is just buying you time so that you introduce the correct supply-side policies there. A lot of candidates will also argue that we should use protectionism. Well, that's fine, except we're part of the European Union, which is a customs union, which is a free trade area, which is meant to bring about dynamic efficiency, free movement of labour, capital and goods. Therefore, we would be breaking the law if we use protectionism against the rest of Europe. Also, the World Trade Organization is very, very keen on free trade, because free trade creates more growth, creates more competition, creates more dynamic efficiency again. We would also be going against them. So it's a very, very difficult thing to introduce. Anyway, how do we improve the trade deficit? Very nice question. It comes up in the exam. Reduce the exchange rate, supply-side economics, interventionist supply-side economics. We could lower aggregate demand, but we don't want to do that one because that would hit the other main government objectives of economic growth and increases unemployment, and try and get research and development moving. And the trade deficit is a serious problem in the UK. I happen to believe that those countries that had real problems were those countries that have very large trade deficits that are in the European Union, like Greece and Spain. But the UK's trade deficit is now 5% of GDP. So that's going to be pretty large as well. Thank you.
Okay, as I was doing lesson 66, I just suddenly thought, actually, what I ought to do is explain how the exchange rate is determined. And the exchange rate in the UK is a freely floating exchange rate. And that means that if there's loads of demand for the currency will go up. And if there's loads of supply for the currency, then the currency will go down. And one of the biggest influences on that is actually if you have a trade deficit. Because if you have a trade deficit, then your imports are greater than your exports. So therefore what you have to do is you have to supply your currency. So you have to supply more currency. And with that currency, you buy the imports. So if we're buying loads of goods, say from Germany, then we supply sterling and we change it into Deutschmarks. So that would increase their exchange rate, but at the same time, it will lower our exchange rate. And the UK has had a trade deficit for the last 30 odd years, which therefore says to you, okay, well therefore why did the UK have a high exchange rate between 1997 and the year 2007? Now the reason why we did have a high exchange rate then, even though we consistently had a trade deficit, was partly because the IMF thought we were a great economy, zero output gap, top nation in the world in terms of macro stability. So therefore people would put their money into the UK, but the people who did also put their money into the UK would also get a reasonable, sorry looking at my pen, would also get a reasonable rate of return on their money. So therefore, I think it's very important to know that between 1997 in the nice decade, we did in fact have a high exchange rate, which made our situation worse. So therefore it was harder for our exporters to sell their goods abroad. So during that period of time, we also had deindustrialisation. Okay, so how is the exchange rate determined? It's determined by the demand and supply of sterling. So for example, if hot money comes into the UK, people demand sterling. If we sell more exports, people will demand more sterling. If there's more foreign direct investment that comes into the UK, people will demand more sterling. And also if the speculators decide it's a good investment to make, then they will also demand more sterling. So that's why the exchange rate could go up. In reality though, the exchange rate has fallen since 2008. Why? One of the reasons is because we have a trade deficit. And if you have a trade deficit, that increases the supply of sterling, and that will mean that our exchange rate will fall. We've also had very low interest rates. That will mean hot money will go abroad because they're only getting a rate of return of 0.5%. So therefore people will move their money abroad, and therefore the exchange rate will fall. Also, if there was much more foreign direct investment going abroad from the UK, say to the African continent where you get the highest rate of return, then that would lead to an increase in the supply of sterling. And also printing money in the UK, when the UK started printing money, £360 billion worth of printed money, then that would lead to less confidence in our currency, so therefore the exchange rate would fall, and that would also help to rebalance the UK economy as well. So the exchange rate is determined by the supply and demand of a particular currency. So when we were last in a semi-fixed exchange rate system, if you just remind you and go over this part again, was we in the ERM, then there wasn't a euro, we wanted to link our currency with the Deutschmarks, we wanted to have a high exchange rate, £1 was equal to 3 Deutschmarks then. We wanted to have a high exchange rate because we wanted to bring down inflation, but at the same time we wanted to try and adjust our economy to the German economy. The German economy had always had a very high exchange rate. However, they'd always done remarkably well, but that's because the Germans are very, very efficient. They've got a really good manufacturing system. They've got the Mittelstand approach. There's lots of cultural and institutional factors as to why Germany does so well. Well, during this period of time, 1990 to 1992 was a complete disaster for the UK economy because we had high interest rates and we had a high exchange rate. We had to have high interest rates because we needed to attract hot money into the UK, because speculators were selling sterling because they realised that eventually sterling was going to fall. The government said we're going to continue in the exchange rate mechanism. However, eventually, even though interest rates have gone up to 40% very, very, very quickly, eventually the speculators won the day. And we had to, in 1992, we had to come out of the exchange rate mechanism, and hey presto, the exchange rate fell, and it heralded the golden period for UK economic policy decision making, where we could have a low interest rate and a low exchange rate, which really helped the UK economy. Now, how did the speculators make all that money? Let's say they just speculated 10 quid. In fact, they were speculating 10 billion quid, but let's say they were speculating 10 quid. So £1 was equal to 3 Deutschmarks, so they would get their 10 quid, take it to a UK bank, they'll get 30 Deutschmarks in return. The exchange rate would then fall to £1 was equal to 2.4 Deutschmarks. If that was the case, then 30 Deutschmarks divided by 2.4 Deutschmarks would equal £12.50. So you could then change your money back into sterling, and you just made £2.50 on a £10 note, which is a 25% return. Okay, so very, very quickly then we've covered 1990 to 1992 again, exchange rate mechanism. Then 1992 to 1996 was a very good period for the UK economy. 1997, 2007, a nice decade with a very high exchange rate, which led to deindustrialisation. And then 2008, the exchange rate fell by 25%. We thought that that would eventually lead to a trade surplus. It hasn't, because our manufacturing sector is so small. That's why I called it less than 66. However, it should be less than 67. And this one I started off by saying, well, how do we improve a trade deficit? Then I started talking about how is the exchange rate determined, and the fact that the UK exchange rate since 2008 has fallen, although recently, actually, as I speak right now, the exchange rate is now going up again, which is hitting our export sector. However, but why is it? Why does the UK have such a large trade deficit? And you probably guessed it already, but I'm just going to put some meat on the bones of this particular subject. Firstly, we had a very high exchange rate between 1997 and 2007. A high exchange rate increases export prices, lowers import prices, therefore we will sell fewer exports. So that's one reason, and that led to a process of deindustrialisation. Can you remember in 1992 the manufacturing sector was 20% of GDP, and in the year 2013 the manufacturing sector is now 10% of GDP. Thirdly, China, the emergence of China, the emergence of South Korea, Samsung, Hyundai, China producing loads of cheap goods, loads of cheap labour, innovation, particularly in South Korea, right? So therefore we can buy our goods much more cheaply. The UK consumer has been on a consumer binge for years and years and years. Therefore they expect to have all of those goods, and we are a consumer-led economy. So certainly that's made a huge difference. China and South Korea have huge surplus. In fact, the country with the largest trade surplus in the world is China. The country with the largest trade deficit in the world is the USA, and hence the balance of power is shifting for that reason. We also have a very high import elasticity of demand in the UK. As we earn more income, a lot of that money will be spent on imports, which actually weakens the multiplier, etc. North Sea oil, well, this is called the Dutch disease effect, and this is a remarkable thing that happens in economics. Sometimes when you have resources, it can almost be bad for the country. So let's assume if we'd never had oil, then our exchange rate would have been much lower, because the demand for our exports, e.g. oil, was much higher, so therefore that increased the exchange rate. So one, our exchange rate would have been lower, and secondly, we would have had to innovate to get over that problem. But instead we just relied on North Sea oil, so therefore the exchange rate was too high. We didn't maybe decide to innovate into new technologies, and therefore that created a problem for the UK. There's been a lack of research and development in the UK, e.g. South Korea. South Korea invests enormous sums of money into research and development, and that country is doing much, much better. We also have a consumer-led economy. We're trying to change that around now. We're trying to rebalance our economy towards investment and exports. But during this period of time, we had a consumer-led economy. Therefore, we're going to buy loads and loads of imports. And finally, although we've been okay in the UK, in terms of our trade deficit, there has been a series of poor economic decision making. You can have a trade deficit for a long period of time, but eventually it's going to catch up with you and your country will become poorer. Warren Buffett always says, in a sense, what happens is you're selling all of your assets. And that's what we've done in the UK. A lot of our big industries are now owned by foreigners, which is good because it brings money into the UK. However, through foreign direct investment, which is actually quite good for the UK economy. If that money had not come in, we would have had to borrow money. So we haven't really worried about the fact that we've had a trade deficit in the past, and it's seen as being the least important policy, and it's partially the least important policy is because the consumer likes to spend lots of money and they're more likely to vote for that particular government to go back into power, because consuming more goods makes people feel wealthier and therefore supposedly happier. So once again, we're back into this idea of self-help, innovation, really, really important. And this idea around here where you have economic imbalances, what does that mean? We have a trade deficit in the UK of 5% of GDP, Greece has a trade deficit of 11% of GDP, Spain 10% of GDP, America I think it was about 7% of GDP, whereas China has a massive trade surplus. That gives China lots and lots of power. Now really what should happen is, as I explained in the previous session, if you have a trade deficit, then the exchange rate should fall. And obviously because China's got a huge trade surplus, what should happen is that their exchange rate should go up. But the Chinese are very, very canny. They have a managed exchange rate and they've always kept quite a low exchange rate because they want to sell lots of exports, because they have lots of jobs related to the export sector. Okay, that may be starting to change, because remember they are decoupling themselves from the rest of the world. So therefore what may happen here is that they will spend more of their own money on their own goods. So therefore they do not need to rely on the export sector. But originally they had to rely on that to become an economic powerhouse in the world today, which they are just about doing. So this is why the UK has